Welcome to the Aequitas Consultus podcast. In this episode, we take a comprehensive look at the impact of artificial intelligence on banking and finance employment across the Asia-Pacific region. From the megabanks of Tokyo to the state-driven deployments in Beijing, from Singapore's government-led upskilling programs to India's hiring paradox, we examine the facts, the market sentiment, and the real consequences for financial professionals across this vast and diverse region. This is not a story of doom. It is a story of transformation, of adaptation, and of the emergence of a new kind of financial professional. Let us begin. My name is David Perron. I am a finance executive with over 20 years of expertise in trade finance, working capital management, and corporate banking. I held senior front office positions at JP Morgan and Barclays, and began my banking career at HSBC. I recently completed an executive master in artificial intelligence. Let us begin our journey in Japan, where the financial sector is at a pivotal juncture, compelled to innovate by the dual pressures of a rapidly aging population and its ambition to maintain technological leadership. The government, through its Financial Services Agency (FSA), has fostered a climate of cautious but deliberate AI adoption, favoring a principles-based, sector-specific approach over broad, EU-style regulation. This strategy appears to be bearing fruit. A landmark report from the Bank of Japan in late 2025 revealed the staggering pace of this integration. Nearly 50% of the nation's financial institutions were already using generative AI, with a total of over 90% either actively using, trialing, or seriously considering its implementation. The primary drivers cited were not merely speculative, but focused on concrete business outcomes, improving operational efficiency, cost reduction, and enabling more advanced analytics. The three megabanks, Mitsubishi UFJ Financial Group, MUFG, Sumitomo Mitsui Financial Group, SMFG, and Mizuho Financial Group, are spearheading this charge. In a move that sent ripples through the industry, MUFG deployed ChatGPT Enterprise to its 35,000 domestic employees and announced a collaboration with the AI startup Sakana AI to co-develop proprietary AI agents, including a specialized AI credit expert. MUFG's CEO, Hironori Kamezawa, has been unequivocal, declaring that companies must become AI native as a matter of survival. Following suit, Mizuho rolled out its own internal generative AI tool, Chat, to all its Japan-based employees. The bank also held an Ideathon, which generated over 2,000 employee ideas for AI use cases, and is now developing a suite of applications to automate complex processes, including the drafting of credit approval documents. The scale of daily use is immense. Tokio Marine, a major insurer, reported that 75% of its employees were using ChatGPT, generating 15,000 queries per day, demonstrating how deeply these tools are being woven into the fabric of daily workflows. This technological acceleration, however, is unfolding alongside a significant recalibration of the workforce. Mizuho has announced plans to reduce its headcount by 19,000 by 2027, and the three megabanks collectively are projected to shed 33,000 positions. While executives are careful not to attribute these cuts solely to AI, the parallel between massive investments in automation and these workforce reductions is undeniable. It signals a fundamental strategic pivot from a labor-intensive operational model to one driven by technology and efficiency, a shift that is profoundly reshaping the future of Japanese banking. Now, turning to the market chatter. This information is not officially confirmed by the banks and reflects discussions and analyses from specialized press and professional forums. Beyond the polished corporate announcements, the sentiment on the ground, captured in forums like 5Channel, is a complex mixture of anxiety, resignation, and pointed skepticism. The headline figure of 33,000 job cuts is a constant topic, with many employees viewing it as the final nail in the coffin for the traditional lifetime employment model. The term rizutora, restructuring, is used with a sense of grim inevitability. A widely held belief is that AI is a convenient public-facing justification for long-overdue cost-cutting measures, made necessary by years of razor-thin margins in an ultra-low interest rate environment. The closure of physical branches in rural areas, for example, is often publicly blamed on AI strategy, a narrative that many insiders find disingenuous. There is also a pervasive fear of a hollowing out of the workforce. Employees describe a potential barbell effect, where the industry bifurcates into a small, highly paid elite of AI specialists and senior managers on one end, and a large, precarious contingent of employees in traditional roles with rapidly obsolescing skills on the other. This prospect is a source of considerable unease. Furthermore, many professionals with direct experience implementing these new systems express doubts about their current capabilities. They speak of persistent challenges with integrating new AI tools into complex legacy IT infrastructure, the poor quality of underlying data, and the surprisingly frequent need for human-in-the-loop interventions to correct errors or handle exceptions. The consensus in these circles is that while AI excels at automating structured, repetitive tasks, it is still a long way from handling the ambiguity and complexity of core banking functions, suggesting a significant gap between executive-level hype and operational reality. Which functions are being most impacted in Japan? The impact of AI is not uniform. It is creating a complex mosaic of transformation across different banking functions. Back-office and operations roles are facing the most immediate and significant disruption. Core tasks such as data entry, transaction processing, account reconciliation, and routine compliance checks are being automated at an accelerated pace. The large-scale job cuts announced by the megabanks are expected to be heavily concentrated in these administrative and operational divisions, as they represent the most straightforward opportunities for efficiency gains through technology. In the realm of credit analysis and underwriting, the transformation is more nuanced but equally profound. The traditional role of the junior analyst, which often involves manual data gathering and report writing, is being fundamentally reshaped. Mizuho's initiative to automate the drafting of credit approval documents with a single click is a prime example of this shift. As AI takes over the mechanical aspects of the work, the role of senior credit officers is evolving. They are becoming supermanagers or overseers of AI models, focusing their expertise on model validation, complex exception handling, and applying human judgment to nuanced cases that fall outside the AI's predefined parameters. Their value is shifting from processing information to interpreting and challenging the outputs of intelligent systems. Customer service is also being reimagined. AI-powered chatbots and virtual assistants are increasingly capable of handling a high volume of simple transactional queries, freeing up human agents. However, this does not eliminate the need for human interaction. Instead, the role of the human agent is becoming more specialized, focusing on more complex, high-value, or emotionally sensitive interactions where empathy, sophisticated problem-solving, and relationship building are paramount. The required skill set is shifting from speed and efficiency to emotional intelligence and complex communication. Now, let us move to China. China's approach to AI in finance is a spectacle of state-driven ambition and deployment at an almost unimaginable scale. The People's Bank of China, PBOC, has actively promoted an AI plus finance framework, creating a unique environment where massive, coordinated investments are the norm. The scale of this commitment is staggering. According to a 2025 white paper by EY, AI and generative AI investment in China's financial industry reached nearly 20 billion renminbi in 2024. In a further display of national strategy, the Bank of China announced it would provide at least 1 trillion yuan, approximately $140 billion, in dedicated financial support for the entire AI industry chain over the next 5 years, from basic research to industrial applications. The Industrial and Commercial Bank of China, ICBC, the world's largest bank by assets, stands as a testament to this strategy. It has deployed a proprietary 100 billion parameter financial large language model to its 400,000 employees. The results are tangible. The bank reports that this model has generated 500 million renminbi in profit contribution and now handles over 1 billion AI calls annually across more than 200 distinct use cases. The Asian banker reported that this system autonomously resolved 90% of customer inquiries, a figure that underscores the industrial-scale efficiency being achieved. Other state-owned giants are following suit. China Construction Bank, CCB, has launched an enterprise-wide model risk management platform that has reportedly reduced model deployment cycles by 2 months and cut model-related risk incidents by 30%. The Agricultural Bank of China has even deployed a virtual digital human receptionist developed by SenseTime in some of its branches. This rapid digitalization is fueled by the unparalleled data ecosystems of mobile payment platforms like Alipay and WeChat Pay, which provide a rich stream of data for training sophisticated AI models for credit scoring and fraud detection. However, this digital shift has a clear physical consequence: the accelerated decline of traditional banking infrastructure. In 2025 alone, over 11,000 offline banking outlets were authorized to close, resulting in a net decrease of over 2,000 branches. This trend directly impacts employment for tellers and local back-office staff, particularly in rural areas. The fintech sector remains a powerful disruptive force, with companies like Ant Group developing highly specialized models like Agentar Fin R1, which is trained on hundreds of billions of financial tokens, relentlessly pushing traditional banks to accelerate their own digital transformation efforts. Turning to the market chatter in China. This information is not officially confirmed by the banks and reflects discussions and analyses from specialized press and professional forums. In private discussions and online forums, the narrative around AI in China is complex. Publicly, there is a current of nationalistic pride. The technological prowess of ICBC and the massive government investment are seen as evidence of China's ascent, leapfrogging Western counterparts. However, beneath this veneer of confidence lies a deep well of employee anxiety. The term Nejuan, involution, which describes a grueling, zero-sum internal competition, is frequently used to characterize the current work environment in the banking sector. The traditional promise of the iron rice bowl, a stable, lifelong career in a state-owned enterprise, is perceived as irrevocably broken. There is a palpable fear among employees that without continuous and rapid upskilling in AI and data science, they will be rendered obsolete. Stories of entire departments being made redundant overnight circulate in private WeChat groups, fueling a sense of precarity. While state-controlled media outlets celebrate AI successes, many insiders are more circumspect. They privately discuss the exorbitant costs of developing and maintaining proprietary AI models, the persistent challenges of poor data quality, and the inherent difficulty of accurately measuring the return on investment for these massive projects. There is also a quiet, unspoken concern about the dual-use nature of these powerful AI systems, with many aware of their potential for enhanced employee and customer surveillance in an already tightly controlled environment. Which functions are being most impacted in China? The workforce restructuring is not just theoretical. It is happening rapidly and with quantifiable impact. In retail banking and customer service, the effect is stark. The closure of thousands of branches directly displaces bank tellers. More profoundly, the impact of AI is seen in the data. One major joint stock bank reported that its AI-powered digital employee now handles 80% of the group's entire customer service volume, increasing the AI resolution rate from 38% to an astonishing 92%. This is not augmentation. It is a direct and large-scale substitution of human labor for routine inquiries. In credit and risk management, the vast digital ecosystem provides a data advantage that is transforming the function. AI models leverage data from e-commerce, social media, and payment platforms to generate hyper-personalized credit scores, enabling lending to individuals and small businesses without traditional credit histories. This has automated a significant portion of the manual data gathering and analysis traditionally performed by credit analysts. Consequently, the role is shifting away from processing and towards higher-level tasks like model validation, risk oversight, and handling complex, non-standard cases that require human judgment. For relationship managers, the story is one of augmentation, but with a distinctively Chinese flavor of intense performance pressure. Relationship managers are not disappearing, but are being reshaped into bionic advisors. They are equipped with powerful AI tools for lead generation, customer segmentation, and personalized product recommendations. This frees them from routine administrative tasks, but also dramatically increases performance expectations. The bionic relationship manager is expected to manage a larger portfolio of clients with a higher degree of efficiency and sales conversion, leveraging technology to achieve new levels of productivity. Moving now to South Korea. South Korea's financial sector is a theater of intense competition, and AI has become the new battleground. The fierce rivalry between the country's two financial titans, KB Financial Group and Shinhan Financial Group, is accelerating a wave of AI innovation that is reshaping the industry. This head-to-head competition is driving both groups to invest heavily in AI talent and deploy a wide array of AI-powered solutions in a race for technological supremacy. KB Financial has been particularly aggressive, announcing plans to invest KRW 1 trillion, approximately $750 million, in AI and digital transformation by 2027. The group is constructing a dedicated AI center and has been on a hiring spree, bringing in hundreds of data scientists and AI engineers. Not to be outdone, Shinhan Financial is matching this ambition with similar investment levels and a strategic focus on building its own proprietary AI models. Chairman Jin Okedong has urged his leadership to become the spark of innovation to elevate the group's future competitiveness. A key trend emerging from this rivalry is the concept of the AI banker, a new breed of employee who partners with AI systems to provide sophisticated, data-driven financial advice. Both KB and Shinhan are actively recruiting and training for these roles, viewing them as the future of customer interaction. However, this intense focus on high-end talent is also creating a brain drain. The most skilled AI professionals are often lured away by the higher salaries, stock options, and more dynamic work cultures of the country's tech giants, such as Naver and Kakao, creating a significant retention challenge for the more traditional banking sector. The Korea Times reported in January 2026 that this rivalry is not just driving innovation but also creating significant pressure on the existing workforce, who feel they must constantly upskill to remain relevant in this rapidly changing environment. Turning to the market chatter. This information is not officially confirmed by the banks and reflects discussions and analyses from specialized press and professional forums. The market chatter in South Korea reflects the country's famously competitive and high-pressure business culture. The rivalry between KB and Shinhan is a constant topic of discussion, with employees and industry observers closely watching which bank will announce the next big AI initiative. There's a palpable sense of national pride in being at the forefront of this technological race, but it is overshadowed by significant anxiety among the workforce. A dominant theme is the fear of being left behind, often described as AI anxiety. The relentless pace of AI adoption and the constant pressure to upskill are creating a high-stress environment. Many employees feel they are in a perpetual state of catch-up, struggling to learn new, complex skills while simultaneously performing their demanding day-to-day jobs. There is also a current of skepticism regarding the true effectiveness of the AI tools being deployed. While the bank's marketing departments tout impressive capabilities, many insiders whisper about the significant challenges of integrating AI with decades-old legacy systems, the need for constant human oversight, and the occasional, sometimes spectacular, failures of AI models in real-world scenarios. There's a sense that the banks are sometimes more focused on the public relations value of being seen as an AI leader than on the actual practical effectiveness of the technology. The brain drain to the domestic tech sector is another major topic of concern. Many of the most talented AI professionals, after being trained and gaining experience within the banks, are leaving for companies like Naver, Kakao, and Samsung. These tech firms can often offer more attractive compensation packages, a more innovative work culture, and the opportunity to work on more cutting-edge projects. This is creating a critical talent shortage in the banking sector and forcing the banks to offer increasingly generous and often unsustainable compensation packages to attract and retain the skills they need to compete. Which functions are being impacted in South Korea? The AI-driven transformation is reshaping the banking workforce in specific, discernible ways. Customer-facing roles are being visibly augmented, with the emergence of the AI banker, who uses sophisticated AI tools to provide more personalized and data-informed advice. However, this augmentation comes with a significant increase in performance expectations. AI bankers are expected to handle larger and more complex client portfolios, meet higher sales targets, and generate more revenue, as the AI handles much of the administrative and analytical heavy lifting. As in other advanced economies, back-office and operations are experiencing significant automation. Repetitive, rules-based tasks like data entry, transaction processing, and standard compliance checks are being progressively automated, leading to a structural reduction in demand for employees in these traditional roles. The focus is on creating a more efficient, streamlined operational backbone for the banks. Credit analysis and risk management are being transformed by the use of AI-powered credit scoring models. This is particularly impacting the roles of junior analysts, who traditionally focused on data collection and preliminary analysis. These tasks are now largely automated. The role of senior analysts is consequently evolving, shifting towards model validation, risk oversight, and making complex judgment calls on loan applications that are flagged by the AI for human review. Conversely, the demand for talent in IT, data science, and AI engineering is exploding. The banks are locked in a fierce competition for a limited pool of skilled professionals, not only with each other but with the entire tech industry. This has made the brain drain a critical strategic challenge, forcing banks to rethink their entire approach to talent acquisition and retention. Now, let us turn to the Anglophone hubs and the Indian paradox. Starting with Singapore. Singapore is executing a meticulously planned, government-led strategy to position itself as a global leader in the AI-driven financial landscape. The Monetary Authority of Singapore, MAS, the nation's central bank and financial regulator, is acting as both a promoter and a prudent overseer of this transition. In a key move, MAS launched Project Mindforge in late 2024, a collaborative initiative that brings together banks, fintech firms, and regulators to explore the safe and responsible use of generative AI in the financial services industry. This sandbox approach allows for controlled experimentation and the development of industry-wide best practices. A cornerstone of Singapore's national strategy is a massive investment in human capital. The AI Singapore program, a government-driven initiative, has set an ambitious goal to retrain 35,000 bankers in AI and data science by 2030. This comprehensive, state-funded effort is designed to ensure that Singapore's financial workforce is equipped with the skills necessary to thrive in the new AI era, mitigating the risk of mass technological unemployment. DBS Bank, the largest financial institution in Southeast Asia, is at the forefront of this adoption curve. The bank has successfully deployed a generative AI-powered virtual assistant to its customer service officers, which has reportedly led to significant improvements in response times and customer satisfaction. However, in a move that underscored the dual impact of AI, DBS also announced in February 2025 its intention to cut 4,000 contract and temporary positions over the next 3 years, directly attributing these reductions to AI-driven productivity gains. This announcement sent a clear signal that AI is a tool for both augmentation and replacement. Other major players, such as ICBC Bank and Standard Chartered, are also deeply invested. ICBC has deployed over 100 distinct AI use cases across various functions, while Standard Chartered has rolled out its proprietary generative AI tool, SCGPT, to thousands of its employees across the region. Turning to the market chatter. This information is not officially confirmed by the banks and reflects discussions and analyses from specialized press and professional forums. In the professional circles of Singapore, there is a general consensus that AI adoption is not a choice, but a necessity for survival in the competitive global financial landscape. The government's proactive stance is widely praised. However, this acceptance is coupled with significant underlying anxiety about job security and the relentless pace of change. The DBS announcement of 4,000 job cuts, even though they were primarily non-permanent roles, served as a stark wake-up call for the entire industry. A dominant theme in private discussions is the fear of a great divide opening up in the workforce between those who are deemed AI-ready and those who are not. While the government's extensive upskilling programs are seen as a crucial and positive step, there are widespread concerns that they may not be sufficient to retrain the entire workforce, particularly older, mid-career employees in traditional roles who may find it more difficult to acquire entirely new, highly technical skill sets. There is also a sensitive and ongoing debate about the role of foreign talent. Singapore has long relied on attracting skilled professionals from around the world to fuel its growth. However, with the intense demand for AI specialists, there is growing concern among local workers that they are being overlooked or displaced by talent from abroad, who may sometimes be hired at a lower cost. This is a delicate political issue in a country that prides itself on social cohesion. Which functions are being impacted in Singapore? The impact is becoming increasingly clear. Customer service is one of the most visibly affected areas. The The deployment of sophisticated AI chatbots and virtual assistants, such as the one used by DBS, is effectively handling a large and growing volume of routine customer queries. This is leading to a structural reduction in the overall number of human customer service positions, even as the complexity of the issues handled by the remaining human agents increases. As in all other advanced financial centers, back-office and operations roles are being heavily automated. The strategic goal is to create straight-through processing environments where manual intervention is minimized, thereby reducing costs, increasing speed, and lowering the risk of human error. This is leading to a steady decline in demand for roles focused on data entry, transaction processing, and other administrative tasks. In contrast, the demand for skilled professionals in compliance and risk management is actually growing. The regulatory environment in Singapore is one of the most sophisticated in the world, and as banks deploy more complex AI systems, they require a growing number of employees who can ensure that these opaque and powerful systems comply with all relevant regulations and do not introduce new, unforeseen risks. The most acute impact, however, is in the talent market. The demand for individuals with skills in data science and AI engineering is exploding. The banks are in a fierce competition for this talent, not only with each other but also with global tech giants and a thriving startup ecosystem. This war for talent is driving up salaries and benefits for skilled professionals and represents the single biggest constraint on the pace of AI adoption in the city-state. Moving now to Australia. Australia's journey into the AI era is proving to be more contentious and publicly debated than in many other parts of the APAC region. The dynamic is characterized by a tense standoff between the country's major banks, which are pushing for AI-driven efficiency and cost savings, and a powerful and vocal union, the Finance Sector Union, FSU, which is fighting to protect jobs and ensure worker protections. This conflict came to a head in July 2025, when the Commonwealth Bank of Australia, CBA, the nation's largest bank, announced it was cutting 45 jobs as part of a strategic shift towards AI. The move sparked a furious backlash from the FSU, which accused the bank of prioritizing profits over people and of rushing to implement technology that was not yet fit for purpose. The union's position was seemingly vindicated when an August 2025 report revealed that CBA had been forced to backtrack on some of its planned cuts after its newly deployed AI chatbot, intended to reduce call center traffic, actually led to a significant increase in call volumes as frustrated customers struggled to get answers from the machine and demanded to speak to a human. Meanwhile, ANZ Bank, another of the Big Four, has also announced plans to cut 3,500 jobs, with a significant portion of these reductions attributed to automation and digital transformation, further fueling the union's campaign. The Guardian newspaper brought a human face to the issue in September 2025 with the story of a CBA employee who lost her job on the very same day the bank rolled out its new AI chatbot. Her story became a symbol of the human cost of automation and intensified the public debate about the pace, ethics, and management of AI adoption in the banking sector. Turning to the market chatter. This information is not officially confirmed by the banks and reflects discussions and analyses from specialized press and professional forums. The public discourse and private conversations in Australia are heavily influenced by the country's strong labor movement and the intense media focus on the social impact of AI. There is a palpable sense of anger and frustration among many bank employees who feel that their employers are demonstrating a lack of loyalty and that the government is not doing enough to protect them from the disruptive effects of automation. The FSU's vocal and aggressive opposition has resonated strongly with a large segment of the workforce, who see the union as their primary line of defense against what they perceive as a relentless march towards automation driven by corporate greed. The well-publicized failure of the CBA chatbot has become a recurring theme in these discussions, often cited as evidence that the banks are recklessly rushing to adopt AI for its public relations value without conducting proper due diligence or fully considering the potential negative consequences for both customers and employees. There is widespread skepticism regarding the bank's claims that AI will be a net creator of jobs. The prevailing belief among many employees is that the new jobs being created will require highly specialized, technical skills that will not be accessible to the majority of the workforce being displaced from traditional roles. There is a pervasive fear that AI will lead not to a transition, but to a permanent and significant reduction in overall employment in the banking sector. Which functions are being impacted in Australia? The impact is broadly similar to that in other developed markets, but the strong union presence and public scrutiny add a layer of complexity and can slow the pace of change. Customer service is being significantly impacted by the rollout of AI-powered chatbots, but the negative experience at CBA has served as a cautionary tale. It has highlighted the need for more sophisticated AI systems that can handle complex queries effectively, and for better training and integration of human agents who must work alongside these new systems. Automation in back office and operations is a key strategic priority for the banks, as they seek to reduce costs and improve efficiency to compete with more agile fintech rivals. However, the FSU's opposition and the potential for negative media coverage mean that banks must implement these changes more cautiously and with greater attention to communication and employee support than their counterparts in less unionized regions. In credit analysis and risk management, AI-powered models are being deployed, but there is a strong emphasis on the need for human oversight to ensure that these models are fair, transparent, and do not perpetuate or amplify existing biases against certain demographic groups. Similarly, while AI tools are being provided to relationship managers, there is a broad recognition that the human element of trust, empathy, and personalized advice remains essential, particularly in the context of a public that is already skeptical of the bank's motives. Now, let us examine India. India presents the most striking paradox in the APAC region's AI story. The country is a global powerhouse in IT services and AI development, exporting software and skilled professionals to the world. Yet, its own large domestic banking sector is facing a significant and socially challenging AI-driven transformation that threatens to eliminate a vast number of entry-level jobs that have traditionally been a gateway to the middle class for millions of young graduates. The most significant and alarming trend is the dramatic slowdown in hiring at major private sector banks like HDFC Bank and ICBC Bank, which have historically been massive job creators. An Economic Times article from March 2025 starkly reported that banks are significantly easing their pace of hiring as technology and AI begin to shoulder more of the operational tasks. HDFC Bank, which in previous years had been adding tens of thousands of employees annually, saw its net hiring slow to a virtual standstill. The bank has deployed a sophisticated chatbot that can reportedly handle over 200 different types of customer queries, directly reducing the need for human agents in its call centers. ICBC Bank has been a pioneer in using AI for credit assessment, deploying models that can rapidly analyze vast amounts of data to make lending decisions, particularly for small-ticket personal and business loans. This has reduced the need for a large workforce of human credit analysts. The Reserve Bank of India, RBI, has been cautiously supportive of AI adoption, recognizing its immense potential to improve financial inclusion and operational efficiency in a country with a vast and often underserved population. However, the RBI has also repeatedly expressed concerns about the potential risks of AI, particularly in areas like algorithmic bias, data privacy, and the potential for systemic risks to emerge from the widespread use of opaque models. The RBI's influential Financial Stability Report has consistently highlighted the need for banks to establish robust governance and risk management frameworks for their AI systems. Turning to the market chatter. This information is not officially confirmed by the banks and reflects discussions and analyses from specialized press and professional forums. The market chatter in India is dominated by the hiring slowdown. For years, a job in a major private bank was seen as a golden ticket for young graduates. Now, many are finding that these opportunities are rapidly drying up. This is causing widespread frustration and disappointment, particularly among the millions of young people who have invested heavily in their education with the expectation of securing a stable, white-collar job. There is a growing fear of a two-tiered labor market, with a small number of high-paying jobs for an elite group of AI specialists and data scientists, and a large pool of low-paying, insecure jobs for everyone else. The issue of algorithmic bias is also a major topic of discussion and concern. In a country as diverse and unequal as India, there is a significant fear that AI credit scoring models, if not carefully designed and monitored, could inadvertently discriminate against certain groups, particularly those in rural areas, from lower socioeconomic backgrounds, or from marginalized communities. This could exacerbate existing inequalities in access to credit and financial services. There is also a profound and often voiced sense of irony that India, a country that is playing a key role in building the AI systems that are transforming the global economy, is also one of the countries most vulnerable to the social and economic disruption that these same systems are causing at home. This paradox is particularly acute for India's massive IT services industry, which has built its success on a model of labor cost arbitrage that is now being directly threatened by automation. Which functions are being impacted in India? The impact is most acutely felt in entry-level and mid-level positions, which form the backbone of the country's large banking workforce. Customer service roles are being significantly reduced by the deployment of sophisticated chatbots by banks like HDFC, which can handle a wide range of routine queries in multiple languages. This is directly impacting hiring for call center and customer support roles. Credit analysis, particularly for the high-volume, small-ticket loan segment, is being increasingly automated. AI models can make lending decisions in seconds, reducing the need for a large workforce of human credit analysts to manually process applications. Back-office and operations roles, such as data entry, transaction processing, and other administrative tasks, are also experiencing a significant reduction in demand as banks move to automate and digitize these functions to reduce costs and improve efficiency. For relationship managers, the focus is less on outright replacement and more on using AI to expand their reach and serve a larger number of customers more efficiently. AI tools are being used to identify potential clients, suggest personalized product offerings, and automate routine communication, allowing relationship managers to focus on building relationships and closing sales. The demand for high-end data science and AI engineering talent is growing, but there is a significant challenge in retaining these professionals, as many are lured away by higher salaries and better opportunities in the global tech sector, both within India and abroad. Moving now to Hong Kong. Hong Kong is strategically leveraging its long-standing position as a premier global financial hub to navigate the AI revolution. The Hong Kong Monetary Authority, HKMA, has taken a proactive and facilitative stance, launching a Gen AI sandbox for the banking sector in December 2024. This initiative provides a controlled environment for banks to test and experiment with generative AI applications, with active guidance and support from the regulator. The goal is to foster innovation while managing the associated risks. The adoption rate is already high. A 2025 report from the Hong Kong Institute for Monetary and Financial Research, the research arm of the prestigious Hong Kong Academy of Finance, found that 75% of financial institutions in the city have already implemented or are in the process of piloting at least one Gen AI use case. This figure is expected to rise to 87% within the next 3 to 5 years. Major global banks with a significant presence in Hong Kong, such as HSBC and Standard Chartered, are actively deploying AI. HSBC has rolled out its AI-powered trading platform, HSBC AI Markets, to institutional clients, while Standard Chartered has deployed its proprietary SC-GPT tool to thousands of its employees in the region. The city's fintech sector is also vibrant, with homegrown unicorns like WeLab partnering with global tech giants like Google to build AI-first digital banks. However, this rapid adoption has created a critical challenge: a severe and growing talent shortage in AI, data science, and cybersecurity. Turning to the market chatter. This information is not officially confirmed by the banks and reflects discussions and analyses from specialized press and professional forums. The dominant theme in professional circles in Hong Kong is the war for talent. The demand for specialists in AI, data science, and cybersecurity is so intense that it has driven salaries for these roles to exceptional levels. This is creating a significant and widening pay gap between those with in-demand AI skills and those in traditional banking roles, causing some tension and resentment within financial institutions. There is also a competitive undercurrent in many conversations, with frequent comparisons being made between Hong Kong's progress and that of its regional rival, Singapore. While the HKMA's sandbox approach is generally praised for its prudence, some insiders feel that it is too cautious and that Hong Kong may be losing ground to Singapore, which is often perceived as being more aggressive and decisive in its national AI strategy. Despite the challenges, there is also a sense of pride in Hong Kong's resilience and adaptability. The city has a long history of reinventing itself in the face of change, and many believe that its unique position as a bridge between mainland China and the rest of the world, its deep pool of financial expertise, and its free market ethos will enable it to thrive in the AI era. The talent shortage is seen not just as a challenge, but also as an opportunity to attract the best and brightest from around the world. Which functions are being impacted in Hong Kong? As a mature, high-cost global financial hub, the impact on job functions closely mirrors that of other major centers like New York and London. The focus is less on large-scale replacement and more on the augmentation of high-value roles. Relationship managers, for example, are being equipped with AI tools to provide more sophisticated, data-driven advice to their high-net-worth and ultra-high-net-worth clients. The goal is to enhance the level of service and personalization, rather than to reduce headcount. Credit analysis and risk management are being transformed by AI-powered models, but there is a strong emphasis on the need for experienced human oversight to ensure that these models are appropriate for the specific nuances of the Hong Kong market and its complex regulatory landscape. The most significant and acute impact is in the labor market for specialized technical skills. The exploding demand and fierce competition for talent in data science, AI engineering, and cybersecurity is the primary constraint on the faster and broader adoption of AI across the industry. The war for talent is not just a buzzword. It is the central strategic challenge facing every financial institution in the city. Now, let us step back and look at the broader picture across the entire region. As we zoom out from the specific circumstances of each market, a clear overarching narrative of profound and irreversible change emerges across the entire Asia-Pacific financial landscape. AI is not a monolithic force but a powerful catalyst, accelerating pre-existing trends and forging new, region-specific paths for the future of work. The strategic responses we are witnessing can be broadly categorized into distinct models of adaptation. First, we have the state-led industrial model exemplified by China and, to a lesser extent, Japan. In this model, national strategy, demographic imperatives, and technological ambition converge. Deployment is top-down, large-scale, and aimed at achieving industrial-scale efficiency and leapfrogging global competitors. This approach has led to the most significant and quantifiable displacements in operational and administrative roles, as seen in the thousands of branch closures in China and the large-scale headcount reductions at Japan's megabanks. However, it has also created a massive state-supported ecosystem for AI development and a new class of highly skilled, highly valued jobs focused on building and managing these colossal AI systems. Second, we see the ecosystem-driven adaptation model in global hubs like Singapore and Hong Kong. Here, the strategy is one of government-facilitated, market-executed evolution. The focus is not on top-down mandates, but on creating a fertile ground for innovation through regulatory sandboxes, massive investments in public-private upskilling programs, and a fierce competition to attract global talent. In these hubs, the primary challenge is not resistance to change, but a severe and structural talent shortage in critical AI-related fields. The narrative is less about immediate, large-scale job losses and more about a widening skills gap, wage inflation for technical roles, and a frantic war for talent that defines the strategic priorities of every major financial institution. Third, the contested transition model is most evident in Australia. Here, the push for automation by financial institutions is met with a strong, organized, and vocal counterpressure from labor unions and a skeptical public. This creates a more contentious and publicly debated transition, where the pace of change is tempered by social and political considerations. The failures of technology are publicly scrutinized, and the rights of workers are a central part of the conversation. This model highlights the critical importance of social dialogue and a just transition framework in managing the societal impact of AI. Finally, India represents the great paradox of this new era. As a nation, it is a veritable powerhouse of AI development and a key supplier of the technical talent that is driving this transformation globally. Yet, its own domestic workforce, particularly in the vast number of entry-level banking roles that have traditionally been a pathway to prosperity, is facing a significant and alarming contraction in opportunities. This highlights the complex, often contradictory, and deeply unequal global dynamics of AI-driven change, where the creators of the technology are not immune to its disruptive consequences. Across these diverse regions, while the structural decline of traditional roles like data entry and routine processing is an undeniable reality, it is not the complete picture. The narrative of pure replacement is being challenged by a powerful counter-narrative of creation and evolution. This transformation is creating a surge in demand for new expertise. In Hong Kong alone, the fintech sector now comprises over 1,100 companies, creating more than 25,000 jobs for skilled professionals. In Singapore, the government's AI Singapore program is proactively retraining 35,000 bankers, equipping them for the future. This is not just about replacing old jobs. It is about investing in a new generation of talent. The so-called war for talent in hubs like Singapore and Hong Kong is a clear indicator of this shift. Far from being a threat, it represents a significant opportunity for professionals, driving up salaries and creating high-value roles in data science, AI engineering, and cybersecurity. We are witnessing the birth of the AI banker in South Korea and the bionic advisor in China, professionals augmented, not replaced, by technology. Their value lies not in processing information, but in exercising critical judgment, providing empathy, and building trust, skills that remain uniquely human. The future of finance in Asia-Pacific is not one of fewer jobs, but of different jobs. The ability to adapt and collaborate with intelligent systems is the new benchmark for success. This transition, while challenging, holds the promise of a more intelligent, more efficient, and ultimately more human-centric financial industry. The time to adapt and seize these new opportunities is now. Before we conclude, an important disclaimer. This podcast is provided for information and educational purposes only. All factual elements are based on publicly available information. Market chatter reflects recurrent discussions in professional circles and should be considered as such. Listeners remain solely responsible for their own decisions.